Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which has been the darling of the mainstream financial media in recent sessions. According to CNBC, Thursday was the first time since 2007 when the S&P 500 index reached 1,500 points, although it gave up some of those gains and closed at 1,494. Still, the exuberance in the markets prompted this headline from Yahoo Finance entitled, "Is the buying opportunity of a lifetime ahead?" If you consider losing money to be an opportunity, by all means, buy away. For those of us that have a modicum of common sense, you would wait for the inevitable pullback. Let's consider the technical arguments. First, for the S&P 500, Thursday's record session charted a doji star, which reflects hesitation amongst traders to push the price directionally. In and of itself, a doji star is a medium to weak trading signal, but I find it significant that it occurred right at the key psychological mark of 1,500. Also note that despite the bullish rise of the index, the velocity of the market action has slowed down significantly, as confirmed by the flatlining of the RSI and MACD indicators. Now let's bring up the Dow Jones. The Dow closed at 13,825, less than 2% off of its all-time closing high set on October 1st of 2007. Many people in the mainstream media cite this as a bullish indicator, but nothing could be more bearish from a value investor's mindset. First of all, when the Dow made its run to 14,000, it did so in a gradual and sustained manner. However, from 2006 until 2008, the number of market participants as a whole began to decline, and that record high in October was achieved on relatively light volume. Ever since the market hit a bottom in 2009, the Dow has been rising, but it's been doing so in a very jagged manner, with each section of bullishness getting smaller and smaller the higher we go. Also note that while we continue this unbelievable rise, the volume keeps declining. This to me is a recipe for disaster, and any piece of bad news could send the markets tumbling. Buyer beware. Finally, let's discuss the precious metals, starting with gold. It was an ugly session on Thursday, with gold dropping down to 1667, or very close to its 200-day moving average. The technical indicators have turned bearish, with both the RSI and the MACD confirming a lack of enthusiasm. The false euphoria in the equity sector will likely pressure gold, but some of the uncertainties coming up with the debt ceiling debates should make this sector a bit of a wild card. For silver, it too had a rough day, failing to secure the $32 threshold and dropping below its 50-day moving average. However, unlike gold, it is still well above its 200 DMA, so there is some good news here. What I don't like is the declining resistance line that is capping silver at lower and lower prices. I feel that it's unlikely we will see a dramatic correction like we did in December, but this is a volatile market, and especially within the current context, I would tread water carefully. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.